The Global Financial Crisis explains. The 2008 global financial crisis was a severe worldwide economic crisis triggered by the collapse of the US housing market and subsequent failures of major financial institutions. It led to a deep recession, significant job losses, and widespread economic hardship. The crisis originated in the US but quickly spread globally due to interconnected financial systems. But how did this come about? In the early 2000s, interest rates were very low. This was due to the Federal Reserve, who responded to the dot-com crash and the 9/11 attacks by decreasing interest rates. The interest rates fell 13 separate times between 2001 and mid-2003, from 6.25% down to 1%. The low interest rates made it very easy to buy houses due to the cost of borrowing being very low. This meant banks were handing out lots of mortgages. Banks were also handing out mortgages to people who could not afford them. This was known as subprime loans. However, banks weren't keen on holding these subprime loans as they viewed them as risky. Instead, they bundled thousands of them together into financial products called mortgage-backed securities and sold them to investors around the world. At the time, this was seen as a smart idea as housing prices were only going up. Meanwhile, rating agencies gave many of these products top grades, even though they were full of bad loans due to the house market exploding. However, with hindsight, we realize this was all built on optimism and overconfidence. By 2006, it started to go downhill. People were failing to pay off their mortgages. The housing bubble popped. Suddenly, the smart investments were no longer smart, and nobody knew which banks were holding the worst of them. September the 15th, 2008, the Lehman Brothers, one of the biggest investment banks in the world, declared bankruptcy. This sent shockwaves throughout the global financial system. Credit froze, businesses couldn't borrow, and the stock markets plummeted. The effect of this was noticeable. Months after, millions had lost their jobs. Global trade shrank. 8 million families had lost their homes in the US. And Wall Street weren't the only ones affected. It had hit everyone around the world. So governments had to respond. The US rolled out a $700 billion bailout to stabilize banks. Central banks slashed interest rates to near zero in a process called quantitative easing. Similar actions echoed worldwide, which saved a complete collapse. However, the effects were still felt. The crisis led to new rules, like the Dodd-Frank Act, to be created. This aimed to prevent a repeat, forcing banks to hold more capital and be more transparent. But many experts argue the system is still vulnerable to different kinds of crises, such as it may not fully address systematic risk, particularly regarding shadow banking and non-bank financial institutions, and could stifle economic growth by burdening smaller banks. Additionally, some provisions, like those related to executive compensation, have been criticised for not going far enough. In conclusion, the 2008 crisis was a wake-up call. It shows how interconnected and fragile our global economy really is.